Good morning, everyone. I am Mike Massari, Strategic Advisor at Redstone, and very, very excited to have this wonderful gentleman talking with me. Today, we're going to talk about what is good enough yield and acceptable risk, which are usually two topics that are very intertwined, and sometimes people think about one or think about the other. Today, we're just going to try to talk about both. I am joined by Charles Jansen, which is Head of DeFi Transformation at S&P Global, and then Ash Morgan, which is Head of Stablecoin and RWA at the Ethereum Foundation, and finally, Marc Boiron, I hope I pronounced that correctly, which is the CEO of Polygon. Guys, I will let you introduce yourself very briefly, and then we'll jump out to the questions right away. Marc, why don't you go first? Yeah.
Sure. As you said, I'm the CEO at Polygon. I'm also a contributor to Katana, which is a DeFi-focused L2 and super app. Before being CEO at Polygon, I was at DYDX, where I was the chief legal officer for that, just doing legal work, mostly in DeFi.
Awesome. Ash?
So I'm at the, sorry guys, I've got a bit of a cracked voice from the last couple of days, but I work at the Ethereum Foundation. Prior to this, co-founded a non-custodial staking network, predominantly focused on APAC, working with institutions to onboard them into the sort of Ethereum staking world and just, in general, the blockchain space. So that was the background, and then joined the Ethereum Foundation 5 months ago to do a lot of coordination with the ecosystem and then institutions around their go-to-market strategies on both sides to meet in the middle and have product market fit around real-world assets and stablecoins.
Hey, I'm Charles Jansen. I lead digital assets at S&P. I need to explain often what S&P is, so people relate. So that's a leading credit rating agency, leading index provider. We created a risk assessment for stablecoin. We rated the Sky protocol not long ago. We got many other type of rating of the sort. We tokenized S&P 500 with Centrifuge, and we got many other initiatives.
Yeah, awesome. I am thrilled to have you all here, and I would want to jump right into the question if you guys are okay with it, because we only have 32 minutes and a lot to talk about. So I was saying I start a little bit with a hypothetical, right? And I know that Marcin was in the panel before, and he likes to talk about hypothetical things, and people like to speculate a lot on what could happen. But if you had $1 million today to deploy into one strategy for 1 year, what APY would be good enough yield for you?
I can start if you want. We don't deploy, right? So I asked somebody that is in the audience which number I should say. He said 80%, because that's what Anchor was. Now, so joke aside, risk assessment is what we do. And when we started this team in 2022, before Terra Luna, nobody cared at all. So, well, if I was to deploy, I would definitely need, and many institutions have this need to have visibility on the risk. There were two limitations that we always had in the field, was the lack of regulation and the lack of visibility on risk. So, yeah, that's...
Yeah, makes sense. I think you guys are doing some great stuff, right? Like, it's super important that S&P are involved in general. You are bringing a lot of legitimacy to DeFi. So we hope to continue to engage there as an ecosystem. On my side, hard to say, the Ethereum Foundation on that front, we deposit a few assets in some of the major DeFi protocols. So I think we're not chasing tons of yield at all, but different risk tolerance with a treasury such as the EF. Personally, at the moment, I'm pretty long ETH, so I would do some staking, maybe in the LSD space. I'd chase maybe 5 to 7, maybe up to 8%.
Yeah, and for me, it just comes down to like basic finance, right? Which is how much is $1 million compared to net worth or my company's assets. If it's a big portion of it, then I'm going to look at treasuries and I'm going to look for some tiny yield on top of that or sit in treasuries. if I'm older, then I'm going to probably be more likely to stay in that. If I'm young, it's a small portion of my net worth, then I'd probably be looking for 10, 15% returns. If I lose some money, it's got many years to make it up. Just kind of basic finance 101.
Yeah, and it's interesting that all of your answers were all based on risk, right? Because this is kind of the core of what we're discussing, that yield and APY especially is not the only thing, but there's also many other factors to consider. One of them being, for example, how the APY is calculated, right? And like where it comes from, this APY. So lots of people, they just stop at the number in itself and they say, oh my God, like 100% APY or 80% APY, that's awesome, but maybe it is not that awesome. So what are, the factors, for example, Charles, in your mind that people should care about to understand and assess the risk of these investments?
Well, I'm not on the analytical side, but so that said, I can answer. One more thing I wanted to mention, though, there is a yield, there's a risk, but when you speak of institution, they care a lot about correlation also. So for instance, you mentioned staking yield. Well, I think they're fairly uncorrelated to many other things. So that's one more factor. Now, when you look at the risk, well, that's what we did for the stablecoin stability assessment. Like the risk of the underlying is always something you should look at. Like if, I don't know, you have a vault, the first factor will be, okay, what is it investing in? But then there's many other factors. There is how the operation of the team doing it. Well, you saw what happened with Paxos and PayPal when they minted $100 trillion by mistake. So that's an operational mistake, operational risk. You look at the track record of whoever is managing this. Of course, now, and that's something I try to explain a lot in TradFi, is we start to have, for all the tokenized asset, we start to have a convergence between classic cyber risk, Web3 more type of cyber risk, including smart contract, but not only, and credit risk, while you can, in some cases, remove some of the counterparty risk. So there's many, many risks to look at. Of course, some company can do it. Usually retail is not very interested in it, but many institutions need independent third party to look at it for them. So that's what we try to do.
Yeah, I think on the product side, totally agree. Go one level earlier and, to the base layer. Blockchain risk in general. Today, institutions, when we talk about real-world assets, a lot of those, and have a home off-chain. It's only when issued natively, these assets, it becomes a lot more of a risk, blockchains in general. And when we're talking about 30, 40 different products on a chain, it becomes incredibly hard to roll a chain back. One financial product broke because the chain went down, 39 didn't. It becomes a lot harder to justify to roll that chain back. And I think we're increasingly going to see a world in which the risk teams at these banks care more and more about the blockchain. So that's generally speaking how we approach things. Going to the product layer, the idea here isn't to take finance and just add a wrapper around it. The idea is to reinvent finance, right? It's to take what exists and 10x it. And that means taking a mortgage-backed security and enabling it to be traded off the balance sheet in a day, not 45 days, not 30 days. And how do we get to that? We create open, transparent, financial products. Yes, a lot of privacy around who holds them, but in general, the product itself, has to be super transparent. And I think that comes, with Oracle infrastructure, with ZK infrastructure around these financial products to look on the inside of them. Who makes up a mortgage-backed security? What are all of the people, the mortgages in each tranche? What are their risk profiles? And, anonymizing all that data. This becomes a product that's incredibly attractive to asset managers who have exposure to these existing products. that costs a lot of money today, but we're increasingly cheapening the way in which you can build these products. And that to me is where we need to continue to push.
Yeah, that's a very interesting point, I think, that you raised, Ash, because one of my questions, which is very appropriate to what you just said, and it's a question for you and for Marc, is do you think that at a chain level, there should be a more systematic approach to these yield products? Because now they're effectively just like a byproduct of the market activity, right? But the chains or the foundations, they not necessarily create products specifically for yield. Do you think that should happen?
I mean, I think there's this history of talking about chains uniformly, and I think very soon we're going to see that like never happening again. In about a year from now, like it'll end completely. Like Ethereum should be completely neutral, and that's it. And people do whatever they want on Ethereum, and it's that simple. A chain like Katana, DeFi-focused chain, has, instead of what I call a lazy bridge, has an app as a bridge, builds an earn product into it. Like probably Katana needs to pay attention to what's actually being offered through that interface. So look, blockchains, especially like completely permissionless, decentralized blockchains, are meant for people to do whatever the heck they want on them, and they should have fun doing whatever they want. Your responsibility comes up when you decide to surface something to people, and what you surface them is something that you should really think about. And I think like a lot of the risks mentioned, I think we're really good. I think like the correlation is probably one of the like least understood risks, I'd say in crypto, like one of the most understood in finance, although hardest to like maybe like simulate, but one of the least understood in crypto that I think is a really big problem. But like just on that risk point, like if you were to go to like a lawyer and say, hey, what are all the risks? They'll literally, we can draft a 20-page document on.
That's
like
why it takes so long to trade these things, because the lawyers have to look at every page.
Yeah,
right?
yeah, exactly. And so I think one thing that might not be popular to say, but like I don't think DeFi lowers your risk at all. Like at all. I think what it does is increase efficiency, which means you can actually maybe get a better risk-adjusted return. But I don't actually think it changes the risk itself in a meaningful way. Like the same risk that exists, I think, exists on chain, and in many cases, it's actually just more hidden, which is problematic. But there's a lot of work being done on surfacing it, which I think is great.
Ash, do you have anything on the foundation side as a counterpoint to that?
Yeah, I guess. Well, like we constantly talk about like Ethereum security, right? And the risk, the risk premium to access yield across the different chains. I think like we're targeting, that area significantly to ensure that people are comfortable operating on Ethereum, issuing assets on Ethereum, bridging across to other environments, but the home, the issuance being on Ethereum. I think that's how we're viewing things. Ethereum as a storage of, a base storage of all of these assets, increasingly so. Ethereum is the home of these transferable real-world assets, stablecoins. I think that's our focus. That's what we're communicating. This is the edge that Ethereum has. It's the most secure, high uptime chain there is, and I constantly reinforce this message and basically the data that supports that statement. We launched institutions.ethereum.org the other day. Please go check it out if you haven't. And we go by market, every single market. We use all the data providers, RWA.xyz, and we give a very clear picture of exactly what I'm talking about here.
So when you guys look at, for example, RWAs or stablecoin, like Charles, maybe this is a question for you in the first instance, is how do you define effectively what is acceptable risk for these assets that are like such at the core level of an ecosystem? And then I suppose follow-up question for you guys, do you think that the infrastructure that we have currently is good enough for that risk to be mitigated, or do you think that the chains should have a bit more of a say into the way that this risk is assessed and mitigated?
Okay, so we don't define what is acceptable risk. The role that we have is to provide visibility on risk.
Yeah, no, sorry. The question was like, what are the factors that you define? Like, within risk and what is acceptable, like acceptable factors as opposed to acceptable risk?
Well, the acceptability is really at the, and that's an important question, right? The acceptability, like what do you accept as risk, is really at the investor level, right? But the problem we have in the field, and we had many times, is people didn't have visibility on what actually was risk. And it's still the case in many conversations. I got conversation with insurance company, and there are some insurance companies that do, for instance, slashing risk. But there are people that work with them that are concerned that, well, there are many other risks around staking that are not necessarily related only to slashing, right? So what is needed is to have as many and as deep framework of risk evaluation, with the goal not to define what is acceptable or not, but with the goal of pricing the risk. Now, if you have that's a topic here, right? If you have a really good yield with a very high risk, I mean, some people will take that chance. Not everybody wants the less risk in the world, the lower risk in the world, because, well, you usually will come with the lower reward in the world. So for us, it's really bringing the visibility on the risk. Now, how it's done will depend on the product. And again, it's more the analytical side that look at it. For stablecoin or RWA, like for instance, if you want to have a rating on a stablecoin, since it's a stable summit, right? We don't have a specific methodology for rating stablecoin. We have a methodology for the risk of depeg of stablecoin that we created, which is a different product, non-rated. If you want to have well, Sky indirectly had, but there are any stablecoin could be rated. Most of them, if they are not uncollateralized, then the way it works is we create a framework for that, where we'll have basically a deck from whoever wants the rating on their product. It will go to the analytical side, which now has a group of experts in digital assets, which was not the case 5 years ago. We didn't have that. And they will be the first one to review the products that need to have the risk assessment. Then they will add people from depending the structure, from the funds team, from the structured finance team, and they'll look at how they will decide to look specifically at this structure. Because speaking of stablecoin, they all target the same thing. They all want to target a peg, but they all do it in different way. So the risk analysis is really not bespoke, but will depend on the structure. And the way it works is really for us is having, or let's say if they define it, really look like a fund, then you'll have all the methodology and the analysts from the fund side working with those from what we call DeFi, but include also centralized finance, looking together all the risk. So it's not like, oh, there's one way to look at the risk, and here it is the one we have.
Yeah, going again back to Ethereum specifically, we have an initiative, the $1 trillion security initiative, and so the idea behind that, right, is we should at some point be able to store $1 trillion in one smart contract. That is the target. We're pushing further and further into this line of thinking, right? What does it mean to have an indestructible network? What does it mean to be up at all points in time? And I think like there is a push here to red team, Ethereum, both at the consensus and execution layer. This is something that realistically has not been engaged upon. Bug bounty scaled to a certain point, but we are focused, entirely on this and building infrastructure around Ethereum. So Aeon, to your point about ensuring, against correlated slashing, I think they wrote a $60 million policy not long ago. Now I know there's teams that are chasing $1.52 billion worth of correlated slashing risk, insurance, and so the reality is there, with some of these big DATs, they're fine to pay 100 to 150 basis points because ultimately they're long ETH and they aren't wanting to lose any of their ETH due to these correlated slashing events. So, the 150 basis points yield is enough for them. So it completely depends on their risk tolerance, the way in which they're interacting with Ethereum, and that. To me, it's finding and pricing the risk, to your point, and this is the internal modeling of all these teams. Like they're ultimately all looking for different things, and I believe that the liquid staking, even the restaking is super interesting. So as long as we take a sophisticated approach there to decentralization of these different service providers, and Symbiotic's an interesting case, enabling all these different restaking protocols, to come, the liquid staking products, and to have that basis of decentralization there. Liquidity, I'm sure will have problems there, and we'll have to work them out over time. But making ETH a productive asset for us is a big focus as well. Like making it. Let's look at just the restaking products that we can build, right? So we can offer this ETH to back insurance products off chain. Now there is this again correlated piece, and there could be systematic contagion risk that we need to look further at. But making ETH a productive asset is super important to us as well. So building from 150 basis point yield on staked ETH right up to 10 to 20% is probably an interesting proposition for those that have long exposure to ETH.
Yeah, in terms of like the idea of like acceptable risk, I don't. Acceptable risk is whatever somebody wants to earn. Like for some people in certain situations, like 40% yield actually makes sense. In other situations, like 3% yield makes sense. And so I don't think we should be defining that. I think we need to do like a 10x better job of like laying out what those risks are. I think we need to continue to do a better job of laying out what the actual yield is, right? Because like one of the risks is your yield is not actually your yield, because so much yield in DeFi isn't actually real yield. But people should just choose what they think is acceptable to them with like the right information.
Yeah, I agree. And ultimately, it's a matter of visibility, right? So you said it yourself, Charles, and Marc as well. People should determine their own like risk factor and what is acceptable, but our job probably as blockchain people or as an infrastructure is to show that risk and like communicate that risk to people. You raise a very good point between what is like the headline yield, right, and what is effectively the risk adjusted yield. What are some ways that, for example, people in the audience can use to determine or to at least have an idea of how much difference there is between the like headline APY of something and the risk adjusted APY?
I think today, this is why S&P is getting involved, right? Because there is a demand for this as asset managers increasingly see the opportunities on chain, to access. And these are global participants that want high quality American assets that have traditionally been a hop, skip, and a jump to get access to. Now they have it on chain. They're the ones that really are pushing for this. The retail audience, I think like just to give a bit of context on that 21, 22 boom, DeFi boom, right? That was 98%, I would guess, whales on Ethereum and just retail participants who engaged in the, basically yield farming and yield, I guess, like wars, like in general, like looking to earn governance tokens to be a participant in the future of the financial markets. And a lot of people lost a lot of money during that period. There were a lot of hacks. We've increasingly, gone, down there with respect to how much is lost in these smart contracts hacks over the last 3-4 years. So different environment. We've never got back to those numbers yet, but now like we are seeing real adoption, real exposure here. And it to me, it's going back to where it was. we were chasing extreme, yield and opportunities, and now it's real. These are asset managers that have not traditionally been able to get into America, with some of these high quality products. And I think that in of itself, the sophistication that's coming into it, they'll demand more and more frameworks. Now, how and what are those frameworks? Like this is the opportunity. I see Redstone, you're releasing like your low risk DeFi, ratings, product, and that's great. We need a lot more of that. I know L2 Beat is doing great things with respect to just chain, L2 chain risk and the stages that we go through. Maybe we were a little hard on the stage 2 piece, so I think we're going to rejig that just a little bit. I know Vitalik and all participants to Marsh, we're all working now with Christoph, the founder there of L2B, to rejig that a tiny bit, because there are, I guess, like it's become this pretty unachievable structure, to hit that stage 2. So there's all different risks across the page, and I think that institutions look at L2B. It's remarkable. We hear about it all the time, having these conversations. So more of it. This is a hard problem to solve, and it's a new risk environment, all the infrastructure. So, yeah.
One of the things that I actually think needs to be like addressed is we talk a lot about like the infrastructure and risk around that and like things of that nature. But there's like there's 2 things to me that are like pretty basic that are like very broken right now. I think the first one is around collateral. Like the idea that like collateral is going to get like changed and your risk profile is going to change with like no information other than like it just happens is like so absurd. I think the idea that like people are going to go to forums is so absurd. Like there was a day where like that's what I would do back in the day. That's like what like Web3 natives do. But now you've got all of these apps that want to just give yield to people, and like you sure as heck better be getting their email addresses and like sending them an email that says the underlying collateral just changed and your risk just went way up. Like that's a massive problem that people like don't get that information. Second one is like DEXs and lending protocols are so different. Like DEXs, like they're decentralized. Like lending protocols, like we got to get rid of this like idea that like lending protocols are like decentralized. Like there's a curator who makes like very meaningful decisions around like your risk. The Aave DAO, controlled by one person or 2, they make very meaningful decisions around your risk. Like that is something that people don't understand. It's conveyed in the same way as like DEXs are conveyed, but like the risk is like insanely different because it's a small number of people or a team that is making those decisions, and that is no different than asset management elsewhere. And it should be viewed in that way. The only thing is the underlying infrastructure is more efficient, and that's great. I think you can like leverage that to get better risk-adjusted return. But like that asset management part is like real, and like we need to treat it that way better because people are gonna end up getting like super hurt one day. So anyway.
A little bit, yeah. The other day, right? Like, I guess like that's a good example of it.
Do you think this is a regulatory problem, or do you think that this is an information problem? And so how do we approach the issue, right? So you're highlighting how maybe a handful of people, you said like 1 or 2 people, but like a handful of people in any given protocol, they effectively make these decisions. And people that invest in these protocols, they don't know. And they don't understand what happens. How do we approach that, like in a systemic way?
I think ultimately with that, right, like the infrastructure bill, negative, positive, we probably should, as an industry, just think about self-regulation. We're moving too quickly for regulators, to realistically understand all of the innovation that's happening. And it's difficult to self-regulate, but this isn't the AI space. This is core financial infrastructure that requires, each each new addition to this stack, it requires a testing. It requires putting it out into the open. The only way this stuff ends up being, truly risk managed is by use. So to limit and regulate this use today would be a travesty, is how I would think about it. There is the yield opportunities within these early stage DeFi primitives and protocols and vaults that we're going to learn all of these things from. They're paying high yield for a reason. You might lose your money. You might lose your stack. And so that's why you're getting the yield like that you are. And that is all codified. That's all in the history book of this space. And we learn, all the engineers learn from that. And to say that, and to define new categories in this space and say, hey, this is the regulation, this is how you should do things, it's just not how it's going to work. We need to continue on the path we are and just take and bring in new participants like S&P Global, and other ratings agencies and invite them in and explain these products. That's the key piece, in my opinion.
So I used to think exactly like you. Then, I got maybe a slightly different view right now. So I think regulation, it depends what regulate and there are motive, etc. But like, for instance, the ECC right now is not the ECC we had 2 years ago, right? And it depends on what your goal is. If you want to get the trillions from the institutions in, with the, for instance, stablecoin, BL, etc., we see the impact that some regulation can have in enabling the field, right? So it does. Then if it's done in a good way, in a bad way, everybody can debate. But the regulation can be made as a basis that defines how, basically what you can or cannot do. Right? If you want the banks in, they need to have the rules of the game. If you don't have rules of the game, they won't play, right? So asset manager can do different things. So I give you an example and how S&P, for instance, relate to that. When we spoke with many regulators, when we speak with regulator and we speak with regulator all the time, we were explaining what was the stablecoin stability assessment. And some, when the stablecoin bill was being done, told us, yeah, well, you're kind of doing the same as what we're doing. Eventually, so it's useful now, but when regulation will be there, what's the point? Well, there are different layers in TradFi too, right? You have a regulation on how bonds should be and all those kind of things. Still, you have different ratings on those bonds. So it serves different roles. So the regulation is not necessarily for like defining the risks that you should be accepting, etc. But it's important to have it to define the rule of the game, right? Because there is existing regulation, you have accredited investor, all those different things. So somehow if we want DeFi to become something really real and accessible, well, you'll have to pass through the step. So ideal scenario is that when it's not, killing the field, and it's done in a way to enable it, which now I think the overall White House angle is they want to be the crypto capital of the world. When they say crypto, they mean blockchain, DeFi, etc. So if they can set up the rules that basically enable participants to get in, then it's productive.
Yeah, I just think this is a transformational product. So I push back a tiny bit. Like the Wright brothers, 2008 to the first commercial flight was 30 years later. I think the rules of this game, we need to spend a lot longer working them out before we say, hey, get the government in and say this is how the plane should be built. Ultimately, the engineers need a lot more time. I think we're still so early. We got 4 or 5 years of DeFi experience. I think we need another 10 to 15. I don't think this is going to take a long time. I would say, I'm less bullish on putting $5 trillion on chain right now. This is going to take a lot longer and people's expectations should be, drawn out, in my opinion.
Yeah, I tend to agree with you. I think but it does depend how you approach regulation, right? Like ultimately, whenever you say let's not have regulation, what you're basically inherently saying is some people are going to get hurt. We're going to learn from it. Then we'll get better. and that's like a better way to do it. I tend to actually think that is a better way to do it, and you end up having, again, like rating agencies and like forced disclosures from like public pressure, and like people start writing articles about how, you know, you continue to have issues, and then suddenly the only way to fix it is actually through, you know, somebody finally saying, okay, well, unless there's risk disclosures on this, I'm not going to do it, and then people start paying for risk disclosures, and then you suddenly have a market that gets set up, and like you're in a good spot. And the question always is, okay, are you okay with some people getting hurt initially? That's like literally how it works. And what I would argue is we're going to get people who are going to get hurt anyway, because regulators are not going to be able to figure it out properly fast enough. And so we might as well let the markets figure it out. And then lastly, I'll just say, like, consumer protection is something that exists in laws anyway. And consumer protection just requires disclosure. So just disclose things properly, and you already have laws that deal with it. And frankly, for people who are not disclosing and are creating tons of issues, like, and frankly, like hiding things, like, honestly, somebody should go after them. Like, don't hide stuff, just disclose it.
Yeah, fair enough. Thank you so much for the conversation, gentlemen. It's been wonderful to have you here. That's all my question so far, but if you have any from the audience, please come find us. Thank you for joining me.
Thank you.